Good morning.
Good morning.
Okay, so today I want us to start off by discussing on the specific investment decisions, specific investment decision, and we shall be discussing three of them. Okay, first one being, should we lease or should we buy an asset? When do we do the asset replacement? And the last one will be on how do we appraise investment in scenarios of capital rationing. Okay, we'll call the specific investment decision. Okay, and go straight. So as a company, when you make the decision as to whether you want to make an investment, of course, definitely, you may want to decide how, therefore, do we acquire this asset? Okay, this is a good investment. It has a positive NPV. But now, how do we acquire this asset? Okay, do we have an outright acquisition? That is, do outright purchase of the asset, or do we decide that you're going to be leasing the asset from the lessor, from the current owner of the asset? Okay, don't forget, at the end of the day, whether you're going to buy the asset or you're going to lease the asset, okay, it doesn't matter. Okay, the company, the project cash flows, it remains the same. Okay, the only difference here is that the way you're acquiring it is different. Okay, so as a company, therefore, the guide to whether you're going to lease or you're going to buy, therefore, will be guided by which of the two options. Okay, between leasing or purchasing the asset, will result to us paying the minimum. Okay, which is going to result us paying a low amount because you're paying. Okay, whether you're going to lease or going to buy is a payment, is a cash outflow. Okay. So, because therefore, you're going therefore to be appreciating, you're going therefore to be advising the company to take the option that will result to the company having the lowest, okay, present value of cost. Okay. So that's the idea. Okay, whether going to lease or going to buy. At the end of the day, the decision is going to be governed, is going to be guided, okay, by which of the alternative will result as paying the lowest amount of money. Okay. So generally, okay, I think you may have discussed this in your accounting, okay, between the different lease contract we can have. Okay, we have the operating lease, we have the finance lease, okay, we have the sales and lease back, okay, finances or capital lease, okay, we have what we call should we sale and lease back, okay. So we just make a mention, the accounting standard normally defines what we call the operating lease, okay, and we say, for example, okay, if the contract is going to be for less than maybe the economic life of the assets, okay, the period, okay, of the contract is going to be, if you compare it with the entire useful life of the asset, okay, it's like 2 years out of the 10. Okay, if the lease period is only for 2 years out of the 10, then this is going to be an operating lease. Okay, because the bulk part of the company useful life still remain 8 years. Okay, but in case the contract period is going to be for the bulk part of the company asset life, then that's becoming for a finance lease. Okay, we'll call capital lease. Okay, definitely in case you have to use the present value. Okay, if the present value is going to constitute, let me just go to the finance lease. If the sum of present value of the lease rental that the game having constitute maybe 90% of, at least 90%, okay, at least 90% of the asset economic life, okay. But this is as per US GAAP, okay. The IFRS doesn't define this, okay. But from a US GAAP perspective, if the company present value of lease rentals is going to be at least 90% of the company current value, then that's become for a finance lease or a capital lease. Okay, okay. So you can use it the same thing in the case of finance. That in case the company, the present value of all the lease rentals you be paying, okay, constitute roughly a huge, substantial, okay, amount of the current value of the asset, that therefore qualifies to be a finance lease. Okay, otherwise it qualifies to be an operating lease. Okay. That's also the case of operating lease. Okay, you know that it's cancelable. Not that is you can cancel it the time you want. However, the penalties that applies, okay, are a bit lower. Okay, if you compare with the finance lease. Okay, then in case you have an operating lease, okay, then you can cancel it without having huge penalties that are going to be imposed on you. However, if it was a finance lease, then definitely if you cancel it, then there will be huge penalties that might be imposed on either party, the lessee or the lessor. Okay. And that's on the finance lease, the operating lease and the finance lease. In the case of maybe the operating lease, okay, there is no second, the lessor, the owner of the asset, okay, during what we call the secondary payment, the secondary period, okay, they can decide to lease the asset to any other party they want, okay. they don't have an obligation. They must lease the asset to pay to the current lessee. There's no that obligation. Okay. However, if there's a finance lease, don't forget the first, if the lessor, the owner of the asset, would want to lease the asset for a secular term, they must, in quote, first consult the current lessee. Okay. If the current lessee doesn't want, then the lessor can go ahead and lease the asset to someone else. Okay. However, the first person who has the first priority for the secondary payment, secondary period, okay, is the current lessee. Okay. And just make a mention that if the current lessee, okay, takes up the contract, takes up the assets, okay, for the secondary period, the amount they pay is very minimal, okay. Well, this is called a peppercorn rent, okay. It's quite minimal, okay. This is called what called the peppercorn rent, okay. Very minimal rent that that the lessee will be getting for the secondary period, okay. That's in case of the finance lease. In the case of a sale and leaseback, okay, another type of lease contract, okay, sale and leaseback, okay, this is where the lessee, okay. Let me illustrate it. I think it's much better for me to illustrate how the contract comes about. A sale and leaseback. In the case of a sale and leaseback, what happens, you're going to have two parties. The current owner of the asset, okay, so you have part A, call this part A, the current owner of the asset, and you have part B, okay. So the current owner of the asset make a sale of the asset to part B, is a sale of the asset. In return, part B, okay, cost pays for the asset. So this is going to be payment, okay, payment for the acquisition of the asset. However, part A enters into a contract immediately after making the sale. Part A enters into a contract immediately after making the sale to lease the asset back. Okay, so here we're going to have him. Okay, so the asset comes back. This is going to be asset through lease contract. Okay, and of course, party A promises party B to be paying lease rentals every now and then. Okay, so rent here. Okay, being so party B will be paying rent. Okay, party A will be paying rent. Okay, we're paying rent to party A to party B. Okay, based on the new agreement they have. So here there'll be a lease contract. Okay, there is a lease contract between part A and part B. Okay, so on the face of it, what has happened? Part A made a sale. There's a sale here, and there has been a lease back. Okay, so I made a sale, then I leased the asset back from part B. Okay, the new owner of the asset. That's simply a sale lease back. Okay. Now what is happening that that's the form of the contract. The economic substance, okay, of the contract is that what's by there is the economic substance of this contract. Because what I've described there is a form, okay, we'll call a sale and a leaseback. But what is the economic substance of this transaction? Brian.
Sorry?
What is the economic substance of this transaction? Okay, what you have here is the legal form of it. Okay, what we call the form. That A made a sale of the asset to party B, then leaves the asset back, okay, for a certain period of time with the promise of paying rent. What's the economic reality behind this transaction? No idea about Brian. Daisy.
I think the rent.
Sorry?
Is it the payment of rent?
No, what is the reality of this transaction? Not the rent, for sure. What's the reality? Because what I've described here, okay, is simply the form, okay, how the legality, okay, if you have to use that term, okay, it's how the transaction is going to go on the face of it. But what's about the underlying economic substance of this transaction?
I don't know that.
Nafisa?
No idea.
Okay, Sanya?
Maybe that the leaser has full control.
Mm-hmm. Yes, so full control. Mm-hmm. Continue.
Yeah, so so the leaser can make decisions. Like since he still has full control, he can decide what to do with the asset or whatever is being leased.
Mm-hmm. Which part is this? A or B?
Um, so if so we're saying that the seller is he's selling it and then leasing it back.
Yes.
So during this whole time, does he still have control of the asset, even
Who?
after he sells it?
Who? Part A has control.
Yeah.
Okay, therefore for part A, what so how do you account for it?
I'm not sure about that.
And again, in case he has full control over part A, it will still make a recognition of the asset in the book. Okay, so therefore part A is going to be in terms of the substance of the transaction, therefore he is the owner of the asset more or less. Okay, even though that the owner, in terms of the legal form of it, B is one who owns the asset. But who derives the economic benefits? It is part A. Therefore, in part A's book, don't forget, we're going to make the part A still continue making the recognition. So in the actual sense, there's no sale that occurred. If anything, what has happened that part A has used the asset. Okay, this was transfer of the asset. Okay, this sale is simply a transfer of the asset from A to B for a loan. This payment here is a loan. Okay, this simply is a loan that part A has obtained from part B. Okay, and they're using the asset as a collateral, as security. Okay, for this loan they have taken. Okay, and of course, since this is a loan, they need to be paying interest and principal. Okay, this rent will be paying is the interest and the principal. The interest and the principal that is due. Okay, the interest and the principal. Okay, so therefore the economic substance is that this was simply is a loan transaction, and part A is using the asset as a collateral against the loan they are going to obtain from party B. Therefore, in part A's books, you again make a recognition of the loan. Okay, therefore, in the other company non-current liability, you make a loan recognition, as well as in the asset, in the non-current asset, we continue recognizing the assets. Okay. And you're going to therefore consider the interest payment, okay, because they have become part and parcel of the interest payment part of it, okay, become therefore this will appear in the profit and loss account, okay, as an interest expense, okay, and the principal is meant to reduce this loan balance here, okay. That's the economic substance of the transaction, okay. That simply is a sale and a lease back, sale and a lease back. Okay, so therefore there are those three forms of lease contracts. Okay, finance lease, operating lease, and you have sale and a lease back. Can you take a minute to go through these notes? But this is a financing decision, which implies therefore we are going to be financing the acquisition through a bank loan. Therefore, the cost of capital, the relevant discounting rate is therefore the after-tax cost of borrowing. Because you may be given two, you may be having two discount rates. Okay, as we shall see in some of the questions, there'll be two discount rates. So which one do you apply? Which one do we use? Okay, we use, if you're discounting the financing cash flow, we use the cost of capital as we use the cost of borrowing as our discounting rate. Okay, if you're discounting the investment cash flow, maybe discount them at the company cost of capital or the project cost of capital, not the cost of borrowing. Okay, but the project cost of capital. Okay. Clear, Brian?
Yes.
Great. Now, what should we lease? Okay, is there any advantage you get from leasing? Of course, there are advantages that we get. One of them definitely is the tax shield. Okay, there's tax saving. Don't forget the lease rental you pay, they are tax deductible expense. Okay, the same we had the case of capital allowances. Okay, but these are tax deductible expenses. Okay, therefore, there's tax saving that you'll be earning as company. Okay, Of course, definitely, since you're taking a lease option, therefore the initial cash outlay is very minimal. Okay, if the lease rental is if that can happen, okay, that you pay the lease rental end of the year, but in most time you pay at the beginning of the year. Either way, the amount you pay if you take the leasing is a fraction of the cost of capital, a fraction of cost of taking up of the purchase option. Okay, that in case you take the person who is going to be purchasing the asset, okay, if the asset cost is 10 million, they pay 10 million. If you take up the leasing option, for example, you're paying every year, let's say like 1 million. Therefore, the initial cash outlay, this is the initial, is quite minimal, 1 million. Okay, as a kind of, therefore, you can be able to access the asset without you having all the money at the upfront, okay, at the year zero, at the initial point. Okay, then the cost of leasing could be cheaper, not always the case, but it could be. Okay, but this is not always the case. Okay, so this is a bit debatable. Okay, that it could be cheaper. Okay, when it comes to leasing as opposed to taking out the finance option, as opposed to the acquisition of the asset, an outright acquisition of the asset. Okay. Then also, if you have to take up what we call an operating lease, okay, then there will be no what we call risk of obsolescence of the asset. Okay, why? Because if, for example, okay, at the end of, assume that you take a 2-year loan, not a 2-year loan, a 2-year lease contract. Okay, if maybe by the end of if the end of year 2, okay, there will be another better, let's say, computer. Okay, assume that you have leased computer or even printers. Okay, like the case of Strathmore. Okay, those printers are on lease terms. Okay, so if, for example, by the end of the current lease term, okay, there's another better printers available out there. Okay, cheaper to run. Then Strathmore going to say, we don't want the old printers. Hey, bring for us. You're going to renew your contract, provided you bring to us the newer printers. Okay, so it's upon the lessor. Okay, it's upon the owner of the assets to bring to the lessee. Okay. Better technology. Okay, so you as the lessee, you don't suffer from using old technology because you have an asset with you. It's for you. It belongs to you. Okay, so however, in case of lease contract, okay, it is possible for you to be able to be updating in quote, okay, your current machinery, for example, okay, without the need for you to have to buy those new machines. Okay. However, in case you are the owner of the asset, okay, you may continue using asset even though if you don't want it. Okay, they know there's another better alternative out there. Okay, but you can't do that. Why? Because if you have to go to outside to buy the asset, then it may cost you more. Okay, and maybe in case you have to sell your current technology, it is going to be very minimal value. Okay. Then also it represents of balance sheet financing that is applied in the case of an operating lease. Okay, that in the case of an operating lease, okay, it is not going to be appearing on the face of the balance sheet that you have taken all this at the amount that we have borrowed in terms of lease contract. It doesn't appear. Okay, so that implies therefore your gearing doesn't change. Okay, as per se. Okay. In case you take up an operating lease, okay. Of course, in case you take a finance lease, okay, and we have done this already. Of course, the company gearing will be increasing, okay, because you have to be reporting the obligation of the finance lease, okay, the current liability as well as the case the non-current liability, which are part of debt, okay. But in case of an operating lease, this doesn't appear, which implies that the company gearing position is not affected, okay. And also, it's a bit flexible, especially in case this is going to be is going an operating lease. Okay, that you may decide, okay, to tweak, okay, the terms of the contract. Okay, you can't do so in case this is your asset. Okay, you have the asset with you. Okay, but as time goes by, you can decide to renegotiate, okay, the terms of engagement. Okay, it's a bit easier. Okay, if you have to compare the case of having you being the owner of the asset. Okay. And of course, maintenance, so we're going to have case of maintenance is being paid by the lessor. So you as a company, you just use the asset, okay? And of course, you're paying a fixed amount of money as the lease rental, okay? The maintenance of the asset, the operating cost of the asset is borne by the lessor, the owner of the asset, okay? So of course, there could be advantages, okay, that comes with you leasing, but of course, there could be some disadvantages, okay, definitely. But it's about trying to weigh, okay, the advantages in case they're not quantifiable. For now, we are going to ignore them. Okay, what matters is can you be able to quantify the benefits, okay, as well as the cost that comes with you leasing the assets, okay, and that's what we're trying to do in this topic. Okay. Now, decide whether you're going to lease or you're going to buy the assets. Okay, as we have mentioned. Okay, we first need to how do you evaluate whether you're going to lease or going to buy the assets? Okay, The point of evaluation, okay, is simply based on the cash flow you'll be receiving, okay, if we are to lease the assets, okay. The cash will be, the cash will be paying if you lease the assets, okay, and the cash flows you'll be paying in case you have to acquire the asset, you have to buy the asset, you have to procure the asset, okay. So those are the two alternatives. Should we, what is going to be best for us as a company? Is it to lease the asset, or is it for us to procure the asset outright? We buy the asset outright, okay. And that decision, as I mentioned, is based on what's the, if I take up the I take the purchase option, okay, what is the present value of all the costs, okay, and the benefits that flows from us acquiring the asset, okay. If you take up the lease option, the lease alternative, okay, what are the present value of all the lease rentals you'll be paying, okay, as a result of us taking the lease alternative, the lease option, okay. As I mentioned at the beginning, we assume that the acquisition, okay, is not going to be done from the company equity. Okay, it is done using loans. We don't have enough money, so we're going to go to a bank, for example, and borrow money to finance this acquisition. So I mentioned this is a financing decision, okay, not an investment decision that we're making. Okay. So if, for example, we take the finance option, okay, if, for example, we take the purchase option, okay, let's buy the asset. If you buy the asset, what happened? In year zero, you have to purchase, this is the initial cost. You have to pay the initial cost of the asset. So in year zero, you're going to have a cash outflow equivalent, okay, to the initial cost, to the cost of the asset. So there'll be a cash outflow there, okay. That's the first financing outflow. But since you do all the assets, since you did buy the asset, so you are the legal owner of the asset. So therefore, who claims the capital allowances? You claim the capital allowances. That implies, therefore, the tax savings, because of the capital allowances, become, therefore, you are benefit as a company. There'll be some tax saving as a result of the capital allowances. Because you own the asset, you can claim capital allowances. Therefore, this is, therefore, a cash inflow. Okay. In the final, don't forget, at the end of the asset life, you can decide to sell the asset. Okay. The scrap value, the disposal value. Okay, you own the asset, so you are the one who can be able to dispose of the asset. Okay, therefore, there'll be a cash inflow as a result of the salvage value, the scrap value of the asset. Don't forget, these cash flows, okay, will not be there in case you take up this option. If you decide to take the lease option, you don't buy the asset, so there's no initial cost. Okay, if you decide to lease the asset, you don't claim capital allowances. If you lease the asset, you don't claim the scrap value. So the easiest way to determine whether cash flow is financing, okay, or is investment, consider if I decide to if I decide to buy the asset, what cash flows will be there in case I only purchase the asset and will not be there if I decide to lease the asset. That's become for financing cash flow, okay. However, if a cash flow is going to be repeated, whether you buy or you lease the asset, then that is an investment cash flow. Which in this case, we don't consider it. We decide to either to lease or buy the asset. If we decide to lease the asset, okay, if we decide to lease the asset, what are the financing cash flow? The lease rental you pay, the rent you pay every year, okay? The lease rental that we pay becomes, therefore, the cash outflow, okay? The tax saving, though this is a tax deductible expense, this is also a tax deductible expense. There will be a tax saving as a result of the rent that you pay to the lessee, the lessor, okay? There was a tax saving, the tax relief becomes, therefore, a cash inflow. This is a cash outflow, this is an outflow, and this is a cash inflow. Don't forget, okay, this cash flow will not repeat, okay, in case you decide to procure the asset, you buy the asset, okay? Because in case you decide to buy the asset, you don't pay the lease rental. There is no tax saving as a result of the lease rental because there's no lease rental in the first place, okay? So as mentioned, because sometimes in most cases, you'll be given a very many cash flows, which can be quite confusing, okay? So which one do we take? You take the cash flow that if a financing cash flow, okay, you take in case I procure the asset, I buy the asset, okay, what cash flow will not repeat, okay, if I decide to lease the asset. And the same applies in case you decide to lease the asset, okay. So if a cash flow appears here and here, then that's an investment cash flow, not a financing cash flow. Which therefore means we ought not take it when making the decision on whether to lease or buy the assets. Clear, Sanya?
Yes, sir.
Great.
Sir,
Yes.
sir, I still don't understand. How is it an investment decision?
How is it?
An investment decision.
No, this is a financing decision. This is a financing decision, not an investment decision.
So like, how is it not a investing decision?
Because we're making a decision. The part of the investment is should we is this investment worthwhile? That's the question what we are trying to answer. Other investment, what we have been doing so far, the NPV, the IRR, that is more towards the investment. Is this a worthwhile investment? Okay, this decision here, we're not trying to make that decision. Okay, what we're trying to say is that how do we procure this asset? Is it through purchase or is it through leasing? Okay, that's what we're trying to. This is the decision we're trying to make here. We are not trying to determine the value of the investment. No, what we're trying to determine here is it how do we acquire this asset? Okay, not whether it's going to be a good investment or not. Okay, how do we acquire this asset? Okay, that's the decision we're trying to make here. Not whether this investment is worthwhile. If the question trying to answer is this investment worthwhile, then that is an investment decision which you've been doing so far. But if in terms of trying to acquire, how do I acquire this asset? Okay, should I go and buy it or should I lease it? Then that's a financing decision.
Okay.
Okay, I was clear.
Yeah.
Yeah, so the main problem you have to be careful of, not a problem per se, but the challenge, okay, will be, okay, making a distinction between financing cash flow and investment cash flow, okay. As I mentioned, okay, for financing cash flow, okay, try to make an observation, okay, what cash flows will not be repeating in case I buy the asset? What cash flow will not be repeating, okay, don't forget it's lease, buy, okay, what cash flow will not be repeating if I decide to buy the asset? Then those are financing cash flows for purchase option. What cash flow will not be repeating if I decide to lease the assets? And those are therefore financing cash flow and the lease alternative. Once you get to know that, then comes easy to understand. And don't forget, this financing cash flow, we discount them at the cost of borrowing. Not the compound cost of capital, but the cost of borrowing. Okay, great. Now there's a question here, examiner. There's a question here which they have given here. Okay, but the best way is for us. Let's just do the one from the examiner. Okay, and you can go through this in 1 minute. Okay, so let's do an example from the examiner. Yes, it is a sub company. This is page 14 in my question bank. A sub company, page 14. So go through it, then we discuss together. A sub company, page 14. Okay, let's attempt to read together. Okay, and I lose Excel. Okay, so you're being asked through whether should we lease or should we buy the asset. Okay, so let's begin with leasing alternative. Okay, let's begin with this option. We decide to lease, okay, log to be paying the lease rental, and you'll be told that the amount of lease rental we're paying per year is this. Alternatively, the company could lease new technology and pay an annual lease rate of 80,000 per year, payable in advance. So you pay in advance, okay? Therefore, you paid four of them. So therefore, we need to get the present value. Don't forget here is present value. So present value of rent, present value of rent, okay, will be equal to every year you pay 38,000. Just put it here in present value. So we have it here. Just drag it down. So here 0, here 1, here 2, here 3, here 4. Okay. You don't forget to pay in advance. Therefore, the rent for year 1 you pay it in year 0. Therefore, you pay 80,000. Okay. We have them in thousands. So the 80,000 for 3 years. So you can drag until for 4 years. Okay, there need to be 4 of them, and therefore, okay. The rent for year 4 is paid in year 3. Okay, as you can see there. Okay. That's the amount you're paying. So this is cash outflow. Let me just put them as negative because this is cash outflow. Okay, let me put them in negative because this is a cash outflow. Then in between, since this is rent you're paying, this is a tax deductible expense. Therefore, there'll be tax saving. They have present value of tax shield or tax savings. Okay, so you need working for that. So let me have working here. Have it here. Tax savings. Okay, annual tax savings will be equal to 30%. Okay, of the allowance, which is this case is therefore equal to 80,000. Okay, but this is a tax saving, therefore it's not a negative, it's a positive. So every year you save 114,000. Okay, 30% of the amount you're paying is a saving to the company, and this between the tax are paid in note. Where is this? When do you pay the tax? The company pays taxation. This is the last paragraph. 1 year in arrears at an annual rate of 30% per year. So therefore, the tax for year 1 is paid which year, Nafisa? Nafisa.
Yes.
Tax for year one. When do you pay the tax for year one?
Year 0.
Okay. You're paying tax 1 year in arrears. Tax for year one. When do you pay it? Brian.
You pay tax for year 1 in year 2.
Yes, they have tax for year one, you pay it in year 2. Tax for year 4?
Year 5.
Year 5. So here we include year 5 therefore. Okay, they have tax for year 1, you pay it in year 2. Okay, which is equal to, okay, leave it here the same because the amount you pay is the same, therefore it remains constant. Okay, at 114,000 cash inflow. Okay, so I can drag it until year 5. Okay, so that's for your the tax saving. Nothing else. That is it for this rental. Okay, sum total. Okay, so this is to be the sum or total, do you want to call it? Okay, year 0 all the way to year 5. Okay, then I get the present value of the cost there. Okay, PV, present value of cost and release alternative will be equal to, you can just call it NPV. Okay, we know this simply the present value. Okay, I discount at the company cost of capital. Now, since this is a finance decision, we assume that we're going to be financing this through a bank loan. And in case you do a bank loan, how much interest do you pay? 8.6%. This is the paragraph just below the number of units, production units. The company can buy the technology, but it will be financed through a 4-year bank loan, paying 8.6% per year before tax. Okay, so let's first get the tax cost of capital. Okay, cost of borrowing. The cost of borrowing will be equal to, you pay 8.6%, but of this is before tax. Don't forget the interest you pay is tax deductible. Therefore, the 70% of it is tax deduction. Therefore, the cost of the company, therefore, 70% times 0.7. Okay. Therefore, the cost of the company, therefore, be equal to, just put it in percentage here. You give us, therefore 6%. How is it 20%? Oh, sorry, this is 0.7, not 0.07. Yeah, 6.02%. Okay, the cost of borrowing. Clear?
Sir, could you please explain that again?
Okay, you borrow at 8.6%, isn't it?
Yeah.
Yeah, so that don't forget this is the cost of the interest you do pay is 8.6%. However, don't forget the interest is a tax deductible expense also, isn't it?
Yeah.
If the number you prepare the P&L before you get the tax, you decide you need first subtract the interest, isn't it?
Yeah.
Yeah, so the interest you pay has tax saving. Therefore, that percent is a saving. Therefore, the cost of the company is 70%.
Okay.
Clear?
Yeah.
Therefore, it is 8.6% times 70% to give us 6.02%.
Sir,
Yes.
could you please repeat the formula?
The formula is simply 8.6% times 1 minus t. So let me just write it down. Don't forget, simply 8.6% times 1 minus tax rate. That way. To give us 6.02. Clear?
No, why did you do 1 minus 0.3?
Because the was 30% is a saving to you, isn't it? Because the interest
Yes.
you're paying is a tax deductible expense. The interest you pay is a tax deductible expense, is a tax saving. 30% of the expense is a saving. Therefore, the cost of the company, therefore, is 20%. Clear, Sakina?
Not yet.
Okay. In the same way we've been doing the same way we've been tax. We've been doing capital allowances. Okay. That if you have an allowance, the same way that assume that the capital allowance is 100,000. Okay. We are saying that 30% of the allowance is a saving to the company, isn't it? Sakina?
Yes.
Okay, so 30% is a saving. Therefore, 30,000 is the saving to the company. Therefore, the cost of the company, therefore, is the total cost minus the saving to give, therefore, 70,000 more or less. This is the cost of the company. This is like the cost of the company. Okay, this is like the cost of the company. So, in case, for example, let's even not use percentages. Okay, let's use figures here. I mean, hope it will make it things a bit easier to understand. If you pay an interest of, let's say, 10K per month, okay, we are saying that, so 30% of it is a saving. Therefore, 10K times 30%, therefore, you have a saving of 30,000. Okay, your net total cost was 10,000 minus the saving here of 3K. Therefore, your net cost, therefore, is 7,000. Clear, Sakina?
Okay, yeah.
Yes, so therefore, it's B 10
So
minus 3.
the cost, the saving here.
Sorry?
We're looking for the cost and not the saving here.
Yes, the cost. Okay, because this is a saving. This is a saving. This is a saving. You're looking at the cost. Yes, yeah, that way. Clear?
Okay.
Okay, great. Okay, therefore, we get a cost of capital of 6.2%. Cost of capital, you go to 6.2%. Okay, now therefore discount, therefore at 6.2%. Discount, therefore at 6.2%. Therefore, NPV is equals. We want to get the present value. Simply get the NPV. Okay, to give us the present value. And here you can discount. Yes, we start from year one. We discount at 6.02. The one I just have here. Okay, from year one all the way to year 5. Okay, then of course I also add year 0. Don't forget, for the NPV you begin from year 0, from year 1. Sorry, not like there. Okay, let's therefore give me what has happened. It's 114. Will you okay? Will you okay? Did I miss a point here? Why do I doubt that answer? I'm doubting that answer. I'm not sure why. Equals NPV from year 1 6.02. Okay, from year 1 380 plus year 0, which is all negative. I'm done with that. Those answers. Not sure why. With the sum is 1064. There's no way it can come to 440. If you look at the sum of those cash flow, what is happening? Yes. Okay. I need to put, I've forgotten my formula. It has to be in percent. And here, it has to be in percent. Okay, so I have put 6.02%. Yes, I think that's what I'm making mistake here. So in the formula, let me just show you the formula. Yes, I had forgot to put the percent. Okay, so 6.02% from year 1 all the way to year 5. Okay, of course, in year 0, I simply just add. Okay, clear?
No, sir.
Okay, so I want to get the sum of present value of cash flows from year 0 all the way to year 5. You can do it manually in case you prefer to do it manually using the tables, but it's going to take a lot of work for you. So what do? You simply equals NPV to get the present value, okay, from year 0, okay, discount at 6.02, okay, percent. Clear there?
So can we say 0.0?
Or you can do so, or 0.0602. That's what you want to use.
Yeah, any is fine. I'm just asking.
Yeah, you can also use it. Okay, from year 1. Don't forget, this is now you define the cash from year 1. Don't forget about that. All the way to year 5. Okay, then year 0. Okay, dog year 0 is already negative, so it has to be a negative. So plus year 0. Okay, now to give for the cash flows, the present order cash flows from year 0 all the way to year 5. Clear?
Yes.
Okay, that's in case we take up Ali's alternative. Okay, now what if now we take the purchase alternative? Okay, purchase option. Okay, purchase option. If we take out the purchase option, we'll have the same year 0, year 0 here, year 1, year 2, year 3, year 4, year 5. If we decide to purchase the asset of course in year 0, you buy the asset. Okay, so initial cost here. So initial cost. And the initial cost of this project is how much? If you buy this technology, how much do you pay? $1 million. You pay 1 million in year 0. So you pay 1 million in year 0. Then in the final year, you can sell it off, scrap value. Don't forget you own these assets, okay? Therefore, in the final year, we scrap it off. And how much do you earn? Year 4. In year 4, if we decide 100,000 cash inflow, so these are possible 100,000. Okay. What else? Don't forget these cash flows. Okay, they should not appear here again. Okay, don't forget here we say this is the lease option. Okay, and this is the purchase option. Okay, so they should not be repeating themselves. Okay, so if you take the lease option, the cash flow should not repeat themselves in the purchase option. Okay, so you see here there was no initial cost, which is here. There's no scrap value here, but it's here now. Okay, so in case there's a cash flow that repeats itself, then that is not a finance cash flow, it's a investment cash flow. Then also, since you own the asset, okay, under the purchase option, therefore you can claim capital allowances. You can claim capital allowances. Why? Because you own the asset. Okay, now therefore claim capital allowances. Okay, put it here. Tax saving. That's what we want. Tax savings. Tax savings as a result of capital allowances. Because as a result of CA. So have here, you can have here, year 0, year 1, year 2, year 3, year 4. So I want to get the capital allowances for each of the year. So I'll begin by getting the NBV, net book value. Then here I can have capital allowances, CA. The examiner knows what CA mean. Okay, so NBV, of course, is 1 million. The net book value. Okay, so the year 0, there's no capital allowances you can claim. But in year 2, in year 1, you claim 25%. Is it 25%? You claim 25% of the value beginning of the year. 25%. The value beginning of the year, which is 1 million. Okay, therefore NBV at the end of year 1 will be equal to 1 million minus the allowance that you have claimed today, year 1, 750. Here the formula you can drag until year 3. Yeah, the formula here you can drag until year 3. Clear? In the final year, don't forget you get back 1 million, you get back 100,000. Therefore, the total allowance you can get, therefore, is equal to the cost of the asset, which is 1 million, minus what you got back, the capital allowances, the scrap value, 100,000. Therefore, the total capital allowance by the end of year 4 is therefore 900,000. You claim 250, 187, 140 in year 1 to year 3. Therefore, you claim the balance in year 4, which will be equal to 900,000 minus the sum of what you claimed so far. You claim 250 all the way to 140,000. Let's therefore claim the balance, therefore, in year 4 of 321,875,000. Clear, Sanya?
Yes, sir.
Great. Okay. Therefore, here you can have therefore tax savings. Brian, are you okay?
So could you please show the workings again?
The workings.
Yeah, like for year 1.
That's for year 1. 25% of the net book value beginning of the year, which is year 0. Clear, Nafisa? Nafisa is clear?
Okay, it's clear now.
Okay, great. Okay.
Thank you.
Therefore, the capital assets you'll be claiming year 1 all the way to year 4. But don't forget you claim in arrears also. Anyway, so there is that percent of the allowance, 30% is got the saving. That's the percent of the allowance, you got for the saving year 1 and all the way to year 4. Okay, so you're done with that. Therefore, you had a scrap value, then here we have done the working. Tax savings on capital allowances. On capital allowances. No, these are capital, they're tax based, therefore they're also in arrears. Because they pay tax in arrears, therefore they're also in arrears. They begin from year 2, because you have the workings here already. And now you can drag the formula, okay, all the way to year 5. Okay. Then you've been told, I think you do pay license fee, isn't it? You pay license fee here somewhere. A license fee of 104 is payable at the start of the first year. This fee increases by 4% in each year. Okay, so here you also pay license fee in case you buy the asset, license fee. Okay, and you pay beginning of each year 114,000. You pay 104,000. The start of the first year. Start of first year is year 0. Therefore, in year 0, we pay 104,000. And this is increased by 4% per year. Therefore, in year 1, end of year 1, which is for year 2, we pay what was previous year times 1.04. Then pay 108 something. 108 was 60. Cash outflow as a license fee. Yeah, the formula you do so until year 3, not year 4. Why? Because you're paying the start of year 4. At year 4, you pay start of year 4, which is the same as year 3. Brian, it's clear.
Yes. Yeah.
Don't forget, the other question is that is license fee? Yes, yes.
But the question says that a license fee of 104 is payable at the end of the first year.
It's end of the first year, not the start of the first year. And it's payable at the end of the first year. Thank you. It's not the beginning, but end of the first year. Thank you. So these workings are, let me just drag the workings. Thank you. It's not the beginning, but end of the first year. Yeah, therefore it's for year 1, year 2, year 3, and year 4. It's the end of the year. End of the first year, yes, end of the first year. Thank you. Okay. The other question is license fee a normal business expense? Sanya?
Yeah.
Is license fee a normal business expense? Do you incur it in the cost of the business? Is it a normal business expense?
I know it's a relevant cost, I think. Is it a relevant cost?
It's relevant. That's why it's relevant. That's why I've subtracted it here. Yes, I agree. It is. But the question is, license fee, is it a normal business expense? Okay. If you, for example, you do pay for if you're Strathmore and you pay for research towards making of, let's say, alcohol, is that a normal business expense for you at Strathmore?
No.
No. If you're EABL, is that normal business? EABL, is it a normal business expense?
I don't think so, because it doesn't happen like every day. It's just for a specific.
Yes, I agree. But what is the nature of business? Okay, let's say yes, Unilever. Okay, you do make Omo. Okay, if you were to invest some money towards research towards enhancement of Omo, is that a normal business expense to you as Unilever?
It's a business expense because that's what they make.
Yes, that's a normal business expense. It's a very normal business expense, definitely. So the question is that if this license fee this company is paid over 104, 108, 112, 116, is it a normal business expense? It's obvious based on that answer. Daisy.
It is a business
expense. Yes, it's a normal business expense. Therefore, you can claim allowance, you can offset it against your profits. Okay, there will be tax savings. Okay, there will be tax savings because of license fee. There will be tax savings. Okay, because of license fee. because it's a normal operating expense. It is within the cost of your operations. There will be tax savings because of the fee you're paying. Okay, it's a normal business expense to you as a company. Okay, therefore there will be a tax deduction because of the license the fee you do pay, which is 30% of how much you pay. Okay, 30% of, don't forget you're paying arrears. Therefore, for year 1, you pay it in year 2. Okay, but for these are savings. Okay, therefore I can begin my workings with a negative here because they're savings, they're cash inflow. Year 1 all the way to year 5. Is that clear, Sanya?
Yes, sir.
Sakina?
Yes, sir.
That is it. Don't forget here, the way I told you before, that cash flow should not appear if, don't forget here, there's no cash flow that has repeated itself here. Okay, in the lease option, there was rent and the tax saving on the rent. So there, in here, there's initial capital, initial cost, scrap value, tax saving because of capital allowances, license fee, and license fee here. It doesn't appear here at all. So if a cash flow is it's here, okay, in this area, and then appears here, there's a mistake you made. The cash flow, this financial cash flow, not auto repeat themselves. Okay, so in case the cash flow is repeating itself in lease option and purchase option, then that's a mistake you made. So you need to go back and try to see where the mistake is. Clear? Okay, great. So we're done with. So let's come the fourth there.
In the lease part, lease option, present value of cost, I get a different answer.
What do you get? Unless 6.02%.
Sorry?
You did use 6.02% to discover the cash flows?
Yes.
And what do you get? Sakina,
Okay.
what do you get? Sorry?
Okay, I think I made a mistake.
Okay, check again then. Okay, so therefore the cash flows, okay, are the purchase option from year 1 all the way to year 5. There's no other cash flow. Just to make a comment here, you told that there'll be some tax saving, not some saving, annual saving, operation cost saving of 5.8, isn't it? Brian, you can see that reduction in cost of operation.
Yeah.
You can see it.
Yeah.
So is that a financing cash flow or investment cash flow? Daisy, that's financing or investment cash flow?
Investment cash flow.
So that's an investment cash flow. Okay. Don't forget that cash flow, whether you're going to lease the asset or you're going to buy the asset, you'll be saving 5.8. It doesn't matter. Okay. So don't forget, if a cash flow appears in both sides, okay, don't forget that's the investment cash flow, not a financing cash flow. Therefore, anyway, so therefore we'll consider it the next part for NPV, getting the NPV. Anyway, they come for the total. Okay, so we call this total cash flow. Yes, we call cash flows. Financing, all these are financial cash flows. Okay, year 0, you can get the sum. Okay. And be careful in case it's an outflow, put a negative, an inflow, put a positive so that you don't confuse. Okay, I need to squeeze some work in here. I'm not sure they can be able to add some lines in your workings. You can't do that in your exam on the Excel between the spreadsheet you give in the exam. Okay, so you need to give your workings space. You can't do this. To insert, you can't insert. Okay, so let me do so. But in your exam, you can't do that. So therefore, the cash flow between year 0 all the way to year 5. So what else? NPV. I guess you're done. NPV. So equals not NPV actually. Let me call it present value because not NPV as per se. This is a present value cash flow. PV of cash flow. But we're going to use the NPV formula. Okay, equals NPV 6.02% between year 1. Don't forget, not year 0, but year 1 all the way to year 5. Then I add year 0 because they're negative. And I get 974, 853.62. Nafisa, is clear?
Yes, sir.
Then make a decision. Okay, should we list, should you buy, Brian?
So,
Mm.
sorry, can you just show me the formula for the present value?
Brian, should we list or should we buy? Brian's not in class. What is happening?
Let's go back to the figures, please.
Oh, the figures. Sanya, you're done?
Yeah.
Buy.
Yeah, the company, definitely the company should buy the asset, okay? Because you see, if you decide to lease the asset, okay, there's an amount to be paying in today's term, present value term. You'll be paying 10 and 22. If you decide to purchase, this is the amount you'll be paying in present value terms. Yeah, the company should therefore buy the asset since it has the lowest present value, of course. Then, of course, we're meant to advise the company should buy the asset since the purchase option is the lowest present value cost. So wait, you're meant to do the lease or by decision? Any question? Okay, no question. So part B, you mean to get the NPV, and of course you advise the company as to whether they should go ahead with the investment. Now that was finance decision, what you've done so far. Now we want to do the investment decision. Is this a good investment or not? Okay, let's do that now. Okay, if we told that this is now part B, part B. So we told that if the company invests in this project, okay, there will be a saving of 5.8 in terms of costing, 5.8 per unit, $5.8 per unit, okay, for 5 years, okay, 5 years. Therefore, so this is saving, annual savings. No, this savings doesn't matter whether you're going to buy or going to lease the asset, okay. That's why therefore I called them investment cash flows. Okay, I hope that's clear. Whether you're going to invest, whether you're going to purchase the asset, you're going to lease the asset, you save the same thing. It doesn't matter. Okay, don't forget. Therefore, you'll be saving per year, per unit is equal to 5.8, but sorry, 5.8. However, this increased by how much? There's an inflation of 5%. Okay, 5% to the power of, we call this 1, the power of that cell there. Got it 1. That's the power, sorry, the power of be that 1. So this, we call this is 1, 2, 3, 4. Okay, that's gonna 4. How would be the saving end of year 1? Total saving, I still multiply with the number of units. In year 1, the units are 60,000, then 60,000, 60. Okay, now the formula, then I can drag it, then I adjust for each of the year. In year 2, the number of units are 75, so I adjust 75, but then others remain the same. 75, this is 70, year 3, 95, 95, this is 80. Yeah, look at the savings per year. Clear? Okay, then you pay tax. Don't forget, this is a savings you have just made. You pay tax on it. Tax savings. Don't get paying tax in arrears. Okay, and you do pay. I will begin my formula with a negative because there's a cash outflow. Okay, times the previous year saving. Then that's for year 1. I do so for the entire 5 years. Okay, year 5. There's nothing else. Is there anything else? Nothing else. Therefore, total cash flow, total investment cash flow, therefore be equal to, simply do the sum. Okay. Year 1 all the way to year 5. And that is it. Now I can get the NPV. It'll be equal to, I discount. These are investment cash flow. Therefore, I discount them at the company cost of capital. And the company cost of capital, we've been told, is equal to 11%. So be careful, because these are investment cash flow, not financing cash flow. Don't forget, for financing cash flow, we discount at 6.02%. Okay, these are investment cash flows. Therefore, we discount them at the company cost of capital, which is equal to 12%, 11%, sorry. 11%, year 1 all the way to year 5. Then don't forget the decision you just made up there. Okay, as part A, the company should buy the asset, and the present value, or simply the cost, okay, was equal to 974,000. Therefore, plus 974,000. I have it here already. Have it here. Because as part A, you had said the company, it's better for the company to buy the asset. Therefore, the cost should be equal to 974,000. The cost, the present value of cost you'll be incurred in case you decide to buy the asset is 974,000. Therefore, NPV, sum of cash flow, minus 974,000. Clear? Brian?
Yep.
Daisy, it's clear?
Yeah.
Let's go for the NPV. Now you can make a decision. Okay, should the company invest or not? The company should invest. Why? It's a positive NPV. The company should invest in the project. Should invest in the project.
What's
Sorry?
because kabur na ko na po to.
Yeah, Takina.
Kaya ko ni ko.
Sir,
Yes, Anya.
why is the tax saving negative?
Tax saving. Why is tax saving negative? So these are tax. These are not saving. These are co-tax. Not saving. These are tax because you're paying.
Oh,
These are
yeah,
not-
okay.
Yes, they're not. You're paying. Clear. And that is it. That's what you're meant to do in that particular part of the question.
So sir, if if we used 102,000 instead of 974,
Use one
I
or
mean
two.
1.1 million.
Or
Yeah,
use this one. Use
present value
22.
of the lease option.
Yes. But why
Yeah,
would you want
so
Mm.
in tax savings, do we use that?
No, because it means you'll be going against your advice here. In the first, you say that in the part
No,
A,
if our advice was to use this one.
in case the advice was to use the lease option, yes, you do that. You go as per what the
Okay.
the advice was just given up there, definitely.
Okay.
So in case, for example, at the purchase option, it was 1050. Okay, it was 1,050,000. Assume that this was 1050, 1050. Then definitely it means you go as per the purchase option or lease option. Well, this is 1022. So therefore here down, therefore be subtracting to get the NPV. To get the NPV here, it'll be equal to the sum minus 1022. That's what we want to mean. I presuppose.
Yeah.
Okay, great. Okay. Yeah, you go as per the advice given there, definitely. What's the present value of the cost and the plan we have taken, we have said we need to take. Okay, you advise the company to take. Clear?
Okay.
Okay, great. And
Yeah.
that's all. Should we lease or should we buy the asset? In that question? Okay, another question. Great. That's on lease or buy decision. Okay. Okay, that's on lease or buy decision. Then the next decision is on asset replacement decision. Okay. So conventionally, as a company, you may want to use the asset for 2 years or 3 years. If, for example, this example you just done here, the asset life is 4 years. Okay, you can decide maybe it's worthwhile. We don't use the asset for the entire 4 year, because don't forget, as the asset ages, okay, its maintenance cost increases. Okay, and as the asset is newer, definitely it has lower maintenance cost. That one is for sure. Okay, so you may want to decide as a company, how long should we use this asset before we buy another one, before we replace it with another one. Okay, so the decision definitely ought to be also be guided, okay, definitely by the present value of the cost or benefit, whichever way it is. Okay, so when it comes therefore to the asset replacement decision, okay, we ought to determine if, for example, I decide to use the asset for 1 year, then that what does it mean? It means I use the asset for 1 year, then at the end of the year, I dispose it off, buy another new one, use it for another 1 year. So the cycle repeats itself to infinity. Okay, that's actually the assumption that we are making here. That if you decide to use asset for 2 years, you buy in year 2020, dispose of in year 2022, buy a new one, use for another 2 years, dispose of in year 2024, another one. The cycle repeats itself until infinity. So what we want, what is going to guide us to make the decision as which of the, what is the time, what's the best time to replace the asset? Okay, then we need to compare. If I decide to use the asset for 1 year, what's the present value of the cost for each of 1 year within the search cycle? Okay, if I decide to use for asset, to buy the asset in year 2020, dispose of in year 2022, then for each of those years, 2020 and year 2021, okay, and year 2022, what's the cost per each of those years? If I decide to use the asset for 3 years, okay, that is 2020, I buy today, 2020, until year 2023, for each of those years, of those 3 years, okay, what's the cost of the company? If we're going to be having the cost being the lowest, okay, if we decide to use for 3 years, so because it's per year, okay, then we advise the company that it is better for you as a company to buy the asset today, dispose of in year 2023, because the cost of each of the year is lower than if you have to buy the asset in 2020, dispose of in year 2022, because the cost per year for the 2-year cycle is much more greater than in case you do a 3-year cycle. Okay, it's called the asset replacement decision. So we determine for each of the year what's the cost of the company. Okay, if there are benefits, of course, we raise the company based on which of the cycle has the highest annual benefits. Clear? Daisy, it's clear?
Yes.
Let's do an example, a very quick example here. Go through this, we discuss together. Question. In this example, we have a project that has a life for 4 years, which implies therefore we can decide to use the asset for only 1 year, disposed of by a new one, or 2 years, 3 years, or 4 years. So we want therefore to advise the company which of those years or cycles is better. Okay, let's read. Okay, I'll do so through Excel. So let's begin therefore. This is replacement cycle. So let's do a 1 year cycle. 1 year cycle. That is buy in year 2020, for example, disposed of a year later. Okay, 1 year cycle. Okay, so therefore, year 0, you buy the asset of cost, then use for 1 year, then you disposed of. Therefore, initial cost, you buy the asset in year 0. Okay, this asset cost how much? This asset cost 4,800. Therefore, negative 4,800. Sorry, year 0. Okay, this is negative 4,800. Then this scrap value, yes, this scrap value. Don't forget, you're going to use it for 1 year and you buy another one. So scrap value year 1 is equal to 3,000 cash inflow. Sorry, not 30, but 3. Then what else is a maintenance? Oh, there's a cash inflow. Okay, cash inflow. Let me just call it cash inflow. They're calling it, which occurs in year one equal to 2700. And that is it, nothing else. Therefore, sum of cash flow. Just call the cash sum of cash flows. Okay, equals sum. Here 0. Okay, then year one. And okay, then PV. This is the present value of cash flow. Okay, simply for PV of cash flow will be equal to NPV. NPV. What's happening? I discount the company cost of capital, which is 10 or 0.1. Year one is okay, 1 year only. Okay, plus year 0. And I get that hits 381.82. Well, this is for that's between today and year's time. Is this already in present value terms? Which means therefore the cash flow, okay, to be received that is going to give us this the equal amount that is going to give us the amount. Don't forget this PV. Just show you this present value is equal to so the present value is equal to the amount. Okay, this is annuity multiplied by the present value and factor. Okay, this for 1 year. Okay. 1 year 10%. Okay, the PV you have it here 381. Therefore 381.82 is equal to the annuity we are discounting, the annuity times present value and factor 10%. Okay, therefore what's the amount? So therefore we hold the annuity here. Therefore the annuity, which is the amount of cash flow that will be incurred, this could be this actually this is a positive to be earned. The amount to be earned in year one therefore will be equal to we call it this, since this is a positive, is a benefit. We call the annual benefit, or simply the equivalent annual benefit. Both is a positive, is a benefit. If it was a negative, is a cost. Equivalent annual is equivalent because it's assumed, it's a notional. Okay, don't forget here we don't have any annuity. So after this annuity here, I've put in the formula here. Where is this? This annuity here, I put in the formula here, is simply I want to like spread over, okay, the amount we are receiving into an equal tranches, an equal amount, okay, but it's not equal per se, okay, in reality, because you can see here cash flow here and here, and they're quite different, so it's not an equal amount, but we want to determine what would be, okay, that what would be, okay, the equal amount that will be earned or to be incurred every year over the life of the particular over that sort of cycle, okay. Therefore, this will be equal to 381. Therefore, and just simply make annuity. So that with the formula. They have annuity here as per the formula. The equal amount, the equal annual amount, 381.82 divided by present value factor, 1 year 10%. Okay. Therefore, the equal amount, which is the benefit this time out, will be equal to just above this would be equal to 381.2. Divide by the factor, and what's the factor? The factor is 10%. This what is the discount rate? 10%. 10% year one, it's 90.91 or 90, and I get 420. Therefore, the equal amount that will be received it will be equal to 420 every year. Okay, to infinity. Don't forget this is to infinity. Every year, if the campus follow a 1 year cycle, every year you'll be getting 420,000. Clear, Brian?
Just repeat kindly.
Every year, don't forget here we're assuming that you're going to buy the asset today, 2020, use for 1 year, then end of year 2021, dispose of, buy another one, all the same cycle repeat until infinity. So every year of those one year, because in this case it's just one year, because you'll be getting for 20,000. Well, this is a benefit you're getting. Clear?
Just highlight the formula for PV again.
Oh, this formula, okay. It's simply, this is the formula actually. You see, this is the formula. 381,000. Here it is. Where is this? 381,000. Okay, you divide by the factor, present value factor. 381, you divide by the present value and factor. So this is from just simply from the table. 381.82. Okay, divide by 0.909. Clear?
On the Excel.
On the Excel itself. It's simply the B45, which is the present cash flow. We divide by the factor. Okay, let me just remove
Okay,
this.
I'm a bit lost. I'm not sure how we got 381.
381 is the present value of cash flow. This is the PV of cash flow for year 1 and for course year 2. That's simply the NPV.
Of 4,800.
Yes, simply the NPV. These are 2 cash flows. We have year 1, year 0, and we have year 1. This is like the NPV of the project, actually. Hey, Brian, equals NPV. Discount at 10%, 0.1. Year 1, because this one year cash flow, then minus year 0 cash outflow.
Ah, okay.
381.
Thanks.
Okay.
Quite a bit.
Therefore, get therefore for 20,000. Okay, this is clear.
Yeah, it's clear.
Okay, great. Okay, that's therefore for a 1 year cycle. Then what if you have to decide to use for 2 years? Okay, let me call this 2 year cycle. Okay, a 2 year cycle. Then the 2 year cycle means you buy it in year 0, use for 2 years, year 1 and year 2. Then end of year 2, dispose of by a new asset. Therefore, year 0 cost, the same follow. Initial cost. How much do you pay? You pay 4,800 negative. Then in the final year, end of year 2, dispose the asset off, get some scrap value. And how much do you get? You would say the asset, you get 1,900. However, don't forget there's some cash inflow that you earn in between the years. Year 1, you earn 2,700. Year 2, you earn 1,700. And that is it. Therefore, sum of cash flow, I'll simply call them cash flows. We could simply the sum. Okay. Year 0 all the way, that is it. Then get the NPV, but let me call them the present value, equals NPV, 10%. These are 2 years, so year 1 and year 2. Okay, minus year 0. And you get 629, that's 629.5. This is going to be earned over 2 years. So per year, how much is the equal amount to be earned? Equivalent annual benefit will be equal to 609.75 divided by the factor for 2 years, 10%, which is 82. As per the table, this is 10%, 2 years, 1.7355, 1.7355, as per the table that I'm using myself right now. It is in 4 decimal places. In case there's 2 decimal places, use 2 decimal places. Therefore, every year you'll be earning 362.82. So year 1, so year 2021, you earn 362. Year 2022, you earn 362 to infinity. Here, Sanya.
Yeah.
Okay, great. That's for a 2 year cycle. What about a 3 year cycle? Same process. Okay, let's do a 3 year cycle. 3 year cycle will be equal to the same process. Will be repeating. Initial cost, you buy it in year 0. So you'll be having year 0, year 1, year 2, and year 3. Okay, so initial cost, I pay 4,800. I buy today. Okay, at the end of the life of the asset, that is year 3. Okay, scrap value, I dispose the asset off. Scrap value. And how much do you earn? You earn 1,000. Then there's some money be earning in between, cash inflows. Okay, year 1, you earn 2,700. The same way you used to earn 1,700, I guess. Yes, and 1,500. And that is it. Okay, you have here cash flows. I think we get the sum. Okay, and I get that. Therefore, again, the NPV. Let me call them present value equals NPV. Okay, 10%, I discount by 10%. Year 1 all the way to year 3. Then I minus year 0. I get 9.79 to be like the NPV of the project, but over 3-year life. What will the amount we see per year, therefore? The equivalent annual benefit. The EAB, equivalent annual benefit, will be equal to the amount you earn over 3 years in present value terms. We divide by the factor for those 3 years. In my example, 10% 3 years is 2.69. As per my table, that's what I'm getting. Therefore, every year, that's how much you'll be earning, 377.09 to infinity. So every year you'll be earning 377,000. Okay, clear, Sakina?
Yes.
4-year cycle. A 4-year cycle, same thing. Okay, initial cost, scrap value. Okay, there's no scrap value, so can do it with it. There's no scrap value by the end of year 4. So cash inflow. The only thing you'll be earning is cash inflow. Okay, so year 0 here. So this is like you buy here asset today, you dispose of in year 2024. Buy another one, then use for 2 years, you dispose of in 2028. Okay, the cycle repeats itself to infinity. Initial cost remain the same. Cash inflow in year 1, okay, 2700, 1700, okay, 1500. Year 4, cash inflow is 1000. That is it. There's no cash flow. So cash flows, you can call them cash flows. Okay, year 1, year 0, sorry. Okay, year 0 all the way to year 4. Then you can get present value of the cash flows, simply which is NPV. Okay, year discount by 10%. Year 1 all the way to year 4, minus the initial investment cost, which is 4,800, and I get 869, but received over 4 years. Therefore, the equivalent annual benefit, okay, the equal benefit per year will be equal to the present value of the benefits. We divide by the discounting factor, 4 years, 10%, which is 3.16, 3.1699, and I get $74 with the amount we received per year. Then make a decision based on what we have here. Okay, which one is better? Okay, is it to use the asset for 4 years, buy a new one at the end of year 4? Is it to use it for 1 year? Okay, so of course, therefore, we base on the benefit to be received. If you do a 4 year, you get 74 per year. If you do a 3 year, you get 377,000. Here it is. So it's a bit more higher, the amount you're getting per year. If you do a 2 year, the amount is reducing to 362. If you do a 1 year, the amount is the highest at 420. So every year to infinity, you get 420 in case you decide to use the asset. Buy the asset today, use 1 year, dispose of, buy a new one. So now we want to advise the company. They have the company. Brian, what's the advice to give?
Do the 1 year.
The company, the advice here, the company should replace the assets every 1 year, since 1 year, replacement cycle has the highest equivalent annual benefit. If these were negative, assume that these present value were negative, it will be a cost. Therefore, we choose the one that has the lowest. Okay, if there were these present values here were negative, okay, if these were negatives here, then to be a cost, we'll call equivalent annual cost. But these are positives now. Okay, therefore, the company should choose the one that has the highest equivalent annual benefits. Sanya, that's clear?
Yes, sir.
Great, and that is it. That's on the asset replacement decision. So once you meet left at level 15, we do an example from your examiner. Okay, fair enough. Then see you at level 15. Then okay,